In August 2026, the VIX touched 14.25, its lowest close of the year. The S&P 500 was near record highs. Textbook logic says low volatility means low risk. But the data tells a different story. The market is not calm, it is crowded. On August 17, 2026, the VIX closed at 14.25, the lowest since the start of the year. That same week, the S&P 500 set a record high. Normally, a low VIX signals investor complacency and stability. But a closer look at Cboe data reveals something odd. The premium for deep out-of-the-money puts, specifically the 10 delta versus 25 delta ratio, sits at the 92nd percentile of the past year. In plain English, while the VIX is on the floor, someone is aggressively buying disaster insurance. The surface is calm, but underneath, there is a rush for lifeboats. This contradiction is where our story begins. The high demand for cheap downside protection suggests that sophisticated investors are hedging against a potential crash, even as the broader market appears complacent. This divergence between the VIX and put premiums is a classic sign of underlying stress. To understand the risk, we need to understand the machine that has been printing money on Wall Street, selling volatility. The core idea is the volatility risk premium, the difference between implied volatility and realized volatility. When you sell a VIX futures contract, you are betting that future realized volatility will be lower than the implied level. The premium you collect is the compensation for taking that risk. Historically, this premium has been positive most of the time, which is why short volatility strategies have been so profitable. But the premium is not free money, it is the price of tail risk. In other words, you are being paid to take on the risk of a rare but catastrophic event. The steady income from selling volatility can be wiped out in a single day if the market moves sharply, as seen in past episodes. The VIX futures curve is usually in contango, meaning futures prices are higher than spot. In August 2026, the front-month future was trading at 16.95 while spot was 14.90, a 2.05-point premium. Selling volatility means shorting this curve. You sell the expensive future, wait for it to converge to spot as time passes, and pocket the difference. Data from Cboe shows that in the first 7 months of 2026, the average gap between implied and realized volatility for the S&P 500 was 5.9 points, and it was positive on 130 out of 143 trading days. This is why products like SVX, which shorts VIX futures, have been so popular. But the machine only works if you survive to expiration. The consistent premium provides a steady income, but it also attracts more sellers, increasing crowding and making the trade more vulnerable to sudden reversals. The crowding is visible in institutional positioning. In August 2025, asset managers held a net long position of about 40,000 VIX futures contracts. By January 2026, that flipped to a net short of about 40,000 contracts. That is an 80,000 contract reversal in just 8 months. This is not a minor adjustment, it is a coordinated bet that volatility will stay low. Bloomberg strategist Michael Ball warned of a severe mismatch between cheap index volatility and rising policy risks, calling it a setup for a volatility liquidation. When everyone is on the same side of the trade, the exit door is very narrow. If the market turns, the rush to cover short positions can amplify the move, as many traders try to buy back futures at the same time, driving prices even higher. Beyond the crowded trade, the VIX futures curve itself has become distorted. Citi's Antoine Porcheret warned of a short flat, long steep shape. The short end is compressed by heavy selling from QIS and volatility carry strategies, while the long end is elevated by pension funds and hedge funds buying long-dated puts for protection. This steepening is unprecedented and dangerous. It amplifies gamma squeezes, turning a 10% drawdown into a 20% crash within 48 hours. UBS's Kieran Diamond describes it as a double-edged sword of low correlation. The Nasdaq and S&P 500 have decoupled, but that compression of macro risk into a spring means a sudden rebound in correlation could send the VIX spiking 20 points in a day. The distorted curve reflects a market where short-term traders are complacent but long-term investors are fearful, creating an unstable equilibrium. The mechanics of gamma squeezes can be understood through the convexity of options. When you sell an option, you collect a premium, but you also take on negative gamma. The change in the options value is approximated by the formula. The PNL is roughly half of gamma times the square of the price move. When everyone is selling volatility, the market's aggregate gamma becomes negative. That means as prices fall, dealers must sell more to hedge, pushing prices down further. This is the feedback loop that turned a minor dip into a crash in 2018. The math is simple, but the consequences are severe. For example, if the S&P 500 drops 1%, a negative gamma position may force dealers to sell a certain amount of futures, which can exacerbate the decline, leading to a self-reinforcing spiral. We have seen this before. On February 5, 2018, the VIX surged 116% in a single day, and the inverse volatility product 14 went to zero. SVXY fell over 90%. The lesson was that when short volatility is crowded, any spike triggers a death spiral. Forced buying of VIX futures pushes volatility higher, which forces more buying. In 2026, the setup is even more extreme: higher crowding, a more distorted curve, and a more concentrated S&P 500, where the top 10 stocks make up about 35% of the index. The new products are designed to be safer, but they cannot change the physics. When the crowd is large enough, the exit is the same. The 2018 event serves as a stark reminder that the risk of short volatility is not just a theoretical concern but a real danger that can wipe out entire portfolios in a matter of hours. The current landscape of inverse volatility products shows how the industry has tried to adapt. SVXY now targets -0.5x the daily return of VIX futures, with about $227 million in assets. SVX targets -1x and has been a star performer, up over 35% from mid-2025 to early 2026. SVOL takes a more conservative approach with -0.2 to -0.3x and adds VIX call options for protection, holding $648 million. VYLD tracks absolute point changes and is up 10.4% since its launch in March 2025. These designs are more cautious, but they all share the same underlying risk. If volatility spikes, losses can be rapid and severe. The reduced leverage and added hedges may mitigate some risk, but they do not eliminate the fundamental exposure to a sudden VIX surge, which can still cause significant drawdowns. The core message is that a low VIX is not a sign of stability but of fragility. The relationship can be expressed as, the VIX level is inversely related to the number of short volatility positions. When the VIX is low, the incentive to sell volatility is high, so the crowd grows. But the crowd itself becomes the risk. If any shock forces a rapid unwind, the VIX can spike violently. This is the self-reinforcing cycle that makes low volatility dangerous. The lower the VIX, the more crowded the trade, and the more fragile the system. For instance, as more investors pile into short volatility strategies, the market becomes more sensitive to any unexpected news, as the unwinding of these positions can amplify price moves, leading to a sudden spike in volatility. So what does this mean for investors? First, do not sell volatility when the VIX is below 15, the risk-reward is terrible. Second, if you want tail protection, use VIX call options rather than products like UVXY, which suffer from contango decay. Third, watch the skew. When the 10 delta put premium is at a high percentile, it means smart money is buying insurance, and you should consider doing the same. The market is telling you something, but you have to listen to the right signals. The VIX at 14.25 is not a green light, it is a warning. By heeding these signals, investors can avoid being caught on the wrong side of a volatility spike, which can occur with little warning and cause significant losses. The VIX at 14.25 is not proof of a calm market, it is a measure of how fragile the market has become. Low volatility encourages more selling, and more selling makes the system more vulnerable to any shock. The smart money is quietly buying cheap convexity, while the crowd is still selling insurance. In this environment, the most dangerous asset is not the risky one, but the one that looks the safest. Short volatility was once the most reliable money machine on Wall Street. Now it is becoming the fastest way to get hurt. Remember, the calm surface hides the pressure below. It is waiting for a reason to break through. The current low VIX is a warning sign, not a signal of safety, and investors should be prepared for potential turbulence ahead. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.